Good afternoon, everyone, and thanks for joining us. I'd like to welcome you to this week's Monday Minute Live Chat hosted by the Canadian Leadership Congress. Today, we're talking about where China fits in a pension portfolio. And to speak about this topic with me, I have Seth Weingram. He is Senior Vice President, Director, Client Advisory with Acadian Asset Management. Welcome, Seth.
Thanks very much.
And I am going to start this by asking you what questions you're getting from asset owners as you talk to them about China right now, and how are you responding to them?
Yeah, that's a great starting point. From our perspective, I'd say that we're getting three main questions from allocators around China, and they really have broader implications for EM investing, generally speaking. First and foremost, allocators have been asking us really how they should approach EM allocations given its ascendance in the benchmark. And specifically, they're thinking about whether they should continue to allocate to EM based on sort of traditional models using the EM benchmark weights, or whether they should start to separate out their allocations to China and then to EM ex-China separately. So that's one major theme. A second line of inquiry is really focused on really what's going on with the onshore Chinese markets. These are equities that are accessible to foreign investors that are traded in, say, Shanghai and Shenzhen, and what the opportunity set in that marketplace looks like. Then finally, I would say that a third set of questions really relates to what's left in that EM portfolio if you carve China out. In essence, what are the characteristics of the ex-China portfolio? Now, for the most part, I think generally speaking, we haven't really seen asset owners quite yet pulling the trigger so much on splitting their EM allocations, but it's certainly on investors' minds right now, and rightfully so.
Yeah, that's a really good point. And I want to talk about what you referred to as China's ascendancy. I think that's a really good point. One of the things we've been seeing a lot in the headlines are, say government moving on certain companies and investor assets, et cetera. And there've been some obvious examples in the last few months. Do you think China's approach to governance and some of these challenges are impacting asset owner decisions in the region, and why or why not?
Yeah, I think there are a couple of issues that are involved there. One of them is there's been a shift in sort of the zeitgeist around China, and I think that the crackdowns, if you will, if you want to use that term, have really interacted with that cross-current more generally speaking. If you think back a few years ago, we saw, piece of marketing literature after marketing literature after marketing literature hyping China A, that sort of thing. And then a few years ago, that started to shift, and there's been more of a focus on geopolitical concerns and so on and so forth. And I think these crackdowns have really played in with that cross current to quite a degree. And I think that is very likely affecting the climate in which asset owners are being forced to behave and forced to make decisions right now. When I think about what's actually going on, though, I think we have to have a little bit of a tempered sort of perspective in terms of the sort of the regulatory climate, if you will. And, first of all, there is something of a logic to the regulatory actions that we've seen. They're focused on social welfare, the environment. They may interplay eventually with national security, that sort of thing. These are announced elements of China's sort of long-term policy. And you can really interpret these crackdowns sort of in that context. Now, there may be other agendas that are involved behind them, political agendas, so on and so forth, but at least they're consistent with this broader policy agenda from China. Now, against that backdrop, in talking about China's ascendance, you have a decades-long trajectory of development. This is, again, we're talking 50 years old at this point, and a very long-term arc of development of China's financial markets, going back at least into the 1990s. And that development has certainly been motivated by a desire to attract foreign capital. And so you sort of think, well, how do the crackdowns, if you will, sort of play against that sort of longer term development trajectory? And I don't think that what we're seeing is something that I would interpret as sort of blocking or marking a major shift in that sort of arc of longer-term development, if you will. Again, it's interpretable in terms of a policy context, and it's not clear, that it is marking a shift away from that longer-term arc of development and liberalization that China has been embarking on for decades.
That's a good point, and puts some really helpful context around that issue. So I think I'd like to go back to your point about China versus the broader, EM opportunity set. And, if you look at how asset owners are viewing China, do you think they're focused on it more in terms of integrating it within a broader EM allocation, or some of them moving forward and considering a China standalone?
Yeah, we know certainly that there are asset owners that have gone down the standalone sort of route. There's no question about that. And some of the Canadian plans, if I understand correctly, were among the first entrants in terms of getting licenses to access certain parts of the onshore China market, and so on and so forth. So there's no question that people have moved in that direction. And there's a great deal of logic behind that. And part of it is that the EM benchmarks that we have out there are really kind of strange animals with respect to China. So MSCI's, which is the most prominent, for example, it has a substantially haircut allocation to that onshore China market. So first of all, it's a large cap, mid cap benchmark. And because the onshore China market is skewed towards the mid and the small cap end of the spectrum, it omits a number of firms. That benchmark also omits a large number of relatively small firms that have in the past required a license in order for foreign investors to buy. And the stocks that are included in that benchmark are included with a very substantial haircut, about an 80% haircut relative to their float. And so what does that mean? That if you're an investor and you're trying to access China, generally speaking, you have an interesting animal in that benchmark that you're really trying to work around. And especially for investors who have an active disposition, that China A market has some really interesting characteristics. And it's underrepresented in that benchmark to begin with. And therefore, if they want to allocate to it, they really have to take really substantial active positions, or even think about taking on a custom benchmark or something like that. And for that reason, a number of investors out there have certainly gone with China-specific strategies, and it may be to access the A-shares market. There may be other motivations behind it, but it certainly did motivate that sort of investment. What we're seeing now from some folks who have gone down that path historically is that they're thinking, okay, well, I've got this China sort of focused investment now. What do I do with the rest of my EM allocation? And that's where these questions around what the EM ex-China benchmark looks like and what that portfolio looks like, which is also a strange animal, if you will, where those questions start coming again.
Yeah, that's a really good point. A shares, this is a really big topic right now. It's of great interest to asset owners. Why do you think A shares are particularly compelling right now?
So I like to look at this in the context of a challenge that EM investors have been facing for some time now, and that's the increased integration of equity markets globally. It's a phenomenon that we see in DM, but it also means that emerging markets have become less distinctive over time relative to developed markets. And what's one of the reasons why investors have gone for emerging markets to begin with? It's because they're looking for a distinctive investment. And if EM is beginning to look more DM-like, well, that erodes some of the special value of EM investing in some sense. And you can interpret China's onshore market as offering something of an antidote to that erosion of distinctiveness. For one reason, the market exhibits more of a local flavor than other segments of emerging markets. It's actually a little bit more frontier-like in terms of some of its characteristics. And there are a couple of different reasons for that. One of them is that if you think about who the marginal investor of onshore Chinese stocks is, it's different than in other market segments, particularly different than in the offshore market, if you will. The retail presence in the onshore market is very large. It accounts for about 80% of the volume. Foreign ownership, while it's been gradually rising, is still quite limited. Another aspect of the onshore market is that the stocks are actually more locally oriented. The companies are more locally oriented as well. As I've mentioned, they skew smaller than in the offshore market. And the onshore market also has a better sectoral balance and has more domestically oriented sectors such as consumer staples and healthcare. Meanwhile, the offshore Chinese market, stocks that are listed in Hong Kong and are accessible through ADRs, they're heavily skewed towards consumer discretionary and communication services. There's quite a concentration there. So you've got some appeal in the marginal investor and in terms of the market structure and the nature of the companies that are in onshore China that helps to explain why this market behaves a little bit more distinctively. Now, in addition to that distinctiveness, the onshore market is really marked by a poor information environment. Many of the stocks are not covered by an analyst, for example. And that poor information environment suggests market inefficiency, which is really key for fundamentally informed active investors. Now, one issue actually is that some people worry that the market is too inefficient, that it's actually irrational, that it's kind of a casino, as the Wall Street Journal years ago termed it. And that would be a problem because if you're an active investor and you're looking for mispriced stocks, you need some assurance that those mispricings are going to be corrected somehow. And so you need some level of rationality in the market. But there's plenty of academic evidence to suggest that there is a reasonable degree of rationality, even in the onshore Chinese market. And we see, for example, efficacy in systematic signals that's quite strong. And so there's quite a good reason to believe that this is an appealing market, both in terms of the appearance of the inefficiencies and also the ability to get compensated for investing in them. So that's part of the story. The other part of the story in terms of why the onshore market is compelling is its size. First of all, there are 4,300 stocks in China's onshore market, and their valuation is something like $4.5 trillion US. That's quite a pool of equities. If you compare it to frontier markets, for example, which have some similar informational characteristics, you're now talking in China's onshore market about a market that is 30 times the size of frontier. Not only is it large, but there's also a high degree of liquidity in those onshore stocks relative to similarly sized stocks in other markets, and reasonable trading costs as well. And so both in terms of the informational environment and the opportunity set, as well as the ability to trade it, there's some real appeal. And that's why China A shares have sort of a compelling nature to them, because you can think about them with those attributes as essentially restocking some of the pool of EM's distinctiveness and the opportunity set for active investors who are sophisticated enough to access that market.
Yeah, I think that's a really good point. And I like how you describe kind of the information environment, around A shares and how you kind of get at that. How hard is that for most pension plans? Some big Canadian plans, of course, have boots on the ground in Asia, but for the most part, plans don't. How do you see asset owners approaching and assessing this opportunity?
Yeah, I think that plays into, the question actually plays into this question of why China has triggered some of these questions among EM investors. And part of the issue is simply the sheer size. When you see a market that in not too long ago was 45% of EM and is still about a third of the EM benchmark, you start thinking, is there something about the size of that market that makes me need to behave differently with respect to my allocation to it, as opposed to what I usually did? And then you've got the distinctiveness of China A on top of that, and it really plays into the decision making and raises some of these interesting questions from the asset owners in terms of how to allocate. I guess one answer to that question, or one way of thinking about that question, is to sort of frame actually the decision process in terms of either systematic approaches or discretionary approaches. Now, we're a systematic manager, as I think most of the audience here probably is aware. And I think that lens really helps to shape the answer to the question. And when you think about what China A represents with that sheer size, if you have a systematic process, that sheer size doesn't matter so much because you've got an investment process that's built to scale. On the discretionary side, you don't. Discretionary processes by definition require, in essence, an army of analysts. They would require an army of analysts to cover China A alone with the number of stocks that we're talking about and with the poor information environment. And so what you essentially have, if you're going down kind of that discretionary path, that's where the boots on the ground, the specialist allocations, really come in. And that, in essence, necessitates bifurcating your allocation into China and then EM ex China. It's very difficult to believe that you're going to be able to pool those, given that sheer size alone, not to mention the distinctiveness, and come out with a satisfying portfolio as a result. The systematic side, I think the discussion is slightly different. Sheer size, as I mentioned, doesn't really matter so much because adding the marginal stock to a systematic process isn't really, there's very low marginal cost. Distinctiveness does matter, however, and in contrast to boots on the ground, when we think about what that means in terms of the systematic process, it means that you do need a specialized adaptation of that systematic process, and you need some richness in that systematic process. And that can come through in a few different things. First of all, you need some custom data sources. The data sources that you're going to use to evaluate onshore China stocks are not necessarily the same ones that are going to be accessible or available in the rest of the EM or frankly in developed markets. If you think about signals, forecasting signals that would be based on natural language processing, for example, you have to deal with a different language. And so there's some stress that's put on and some requirements that are put on, even in terms of the data sources that you use. Once you get to forecasting, you've got some other requirements. We find, for example, that a different mix of signals is valuable in the onshore Chinese market, in part because of the different market structure. There are, for example, some very well-known results even from the academic literature that show that certain types of signals that work in other markets don't work terribly effective there. For example, some generic sort of momentum formulations haven't shown to work very well in the onshore China market historically. And we find that in more sophisticated signals that we use, that in some cases, those signals behave very differently in China because, for example, of the high level of retail participation in that market relative to others. And so what that's telling you is that for the systematic strategy, you certainly need a high level of sophistication, you need some specialized adaptation. But if you have enough richness in your process, you can still add in those China A stocks into your broader EM portfolio. And in fact, theory tells you that's probably the first best thing that you could do, because bifurcating the allocation up front from the get-go is going to impose constraints on your investment process that you would expect to have a cost in terms of performance. You want to give your investment process as much unfettered room to run as it can. And those constraints, if you impose them up front, you would expect them to have some cost in terms of performance. So you get an interesting sort of dynamic here in terms of what asset owners, how they need to think about this issue. If you're going down a discretionary path, you've got one set of considerations. If you're going down a systematic path, you may actually come out with a different sort of answer. So that's a little bit of a perspective from the standpoint of the systematic process in terms of the thought process for asset owners, for allocators.
I'm fascinated by your discussion of data and signals as it applies to China and the A-shares market. And I'm wondering, you mentioned a couple of signals that aren't particularly reliable in the context of China. Is there like a particular signal or something that does work that you found effective? And why is that?
Yeah, I think there are, let me speak to a certain sort of theme, if you will. And that theme would relate to certain informal networks that we find that we can tap through various different information sources and more sophisticated modeling. It may be the case that certain types of fundamental information in classes of signals they may not be as effective in China because there's a different prioritization in terms of whether investors are going to key off of that fundamental information that they can get from financial statements, or whether they're going to use other types of networks, for example, in order to identify which stocks that they want to invest in. So if you have a systematic process that has enough sophistication to tap those informal networks and to access to essentially form a picture of what those informal networks look like, you may have the ability to come up with better predictive signals than if you're sticking to some of the more high-level information, the sort of classical information that you might think would be effective based on historical efficacy from other markets. And that's another example of the way in which the onshore Chinese market tends to behave a little bit differently than some of the others. But I would also add that, look, across various different markets around the globe, we see different behaviors. If you're a global investor and if you're an investor in emerging markets, this type of thing is something that you become very much used to in the systematic investing world. The weights that you apply to signals in one environment, they're going to be different from the weights that you apply in another environment, and those weights will change over time. We see issues like this with respect to ESG, for example, with the way that carbon is being valued in different markets, evolves over time. So China A, it has its own set of differential qualities, but it's not I like to think of China A as being distinct enough to provide a special and different sort of environment, and the size of that opportunity set and its tradability is really attractive and appealing to us. On the other hand, it's not too distinct for the application of systematic processes, and it's not too distinct to prevent us from being able to incorporate that market into a broader portfolio.
Yeah, I think that's a really good point. We've been talking about data, talking about signals and benchmarks. ESG is an area where, let's say, the data set is evolving and there's some holes. Are there opportunities to take an ESG approach to China and more broadly its role in emerging markets? And if so, what does that look like?
It's a really interesting question, and this is one that I think is going to be the answer to that question is going to be very different for different investors. When we think about the issues around investing in China right now, we do think of it in terms of these two poles, where you've got one that still represents that view that China is an opportunity and that it may have a stronger growth trajectory, and that it also has this active opportunity set. And I think you can also apply some ESG elements to that. On the other hand, you've got this pole that not only sees China as a geopolitical threat, but also sees it as seriously compromised from an ESG perspective. And I think one of the issues that's really affected the conversation around investing in China is how vocal the two poles, how prominent these two poles really have become. And I actually think that most investors are somewhere along the spectrum, running between these poles, but it's very difficult not to have a conversation that's really affected or charged by these different viewpoints. And ESG is certainly a hot button issue in that regard. On the one hand, you have certain investors or certain observers who are very deeply concerned by the human rights track record that they perceive from China. On the other hand, you have observers who look at the improvements in quality of life in the Chinese population, for example, and champion that aspect of the ESG track record. In addition, you have sort of a rapid evolution in some sense of China's environmental policy, with a number of ESG or environmental elements, if you will, that are part of the announced policy agenda, as well as clearly a social element in the announced policy agenda that is affecting these crackdowns and the regulatory actions that you commented about earlier. For ESG-oriented investors, I think this creates a very complicated map back to subjective values and back to subjective views on what all of these elements look like. And I think it creates some really interesting questions. And one way to think about the magnitude of this issue from an ESG perspective, I think, sometimes we tend to think of it as a little bit of a sideshow relative to other ESG issues. I mean, think about the size of China, even in the MSCI benchmark, which again underrepresents China's economic footprint. But in the MSCI benchmark, you're talking about a third of the EM index is in China. That dwarfs the size of other potential ESG issues, in essence, that you find. For example, decarbonization, if you include some fairly liberal definitions of what that would entail, it might affect 10% or something along those lines of an EM portfolio, using, again, conventional sorts of definitions. What you do with China, and if you're an ESG-oriented investor with specific views, clearly is a much larger ESG issue than, say, that decarbonization piece. And I think that's an interesting way to frame it. But there's no single answer, especially in this highly polarized environment, in terms of how different values-oriented investors are going to behave with respect to China in an ESG context. But I would say, if, again, as you think about, how your investing approach might be affected by that question, you're thinking in terms potentially of some material changes in the portfolio. And I think you need to be looking at what sort of machinery you would need in order to offset the changes in the portfolio, that could be engendered by modifications on an ESG or some other sort of basis around that China allocation.
Yeah, I like your point around China's role in the broader benchmark. I mean, it's huge. So what, in your view, exposure to China do you recommend for asset owners?
Yeah, again, I think I trace it back to the comments about two things. First of all, if you're leaning into China, what should you do? If you're leaning away from China, what should you do? And for investors, and I like to think of that discussion, I think it's clarifying to think of it a little bit in terms of those two poles. And again, acknowledging that most investors are going to be somewhere in the middle, I think it's clarifying to think of it from the standpoint of those different endpoints. With respect to investors who are leaning into China, I think it's difficult to escape this notion that the China A universe offers a really compelling active opportunity set. For all of the reasons that we discussed earlier. And so I think it likely should form a material portion of an investor's allocation. Again, how you think about whether or not your China exposure should be part of a pooled sort of EM portfolio, or whether you want to bifurcate it into an EM ex-China sort of allocation. I think that depends on a couple of different elements. One of them would be your governance constraints. Can you wear the active risk that would be required to have a potentially material overweight to China in a pooled EM portfolio, and to have a material overweight to China A even within your China allocation as part of that broader EM portfolio. And then the second issue that allocators would need to think about with respect to that issue is, what is the nature of the strategies that you're looking at? Again, if you're thinking about a systematic strategy, I think there's a good argument that you would want to pool the allocation, and if you can stomach it, wear the active risk or have a custom benchmark. But if you're going down the discretionary path, then you're probably looking at a bifurcated allocation between the two sort of elements. So I think that sort of frames the way that I would think about allocation from the standpoint of the investor who's looking to lean into China. You're going to have some sort of emphasis on China in that portfolio. It may be formed around your perception of China's economic weight in EM, share of corporate revenues, something like that, and think about what that total China exposure looks like relative to the benchmark. And then within that exposure, you're probably going to want to have a material allocation to active strategies in the onshore market. And again, if you're going down the discretionary path, or if you don't have the ability to pool the allocation, that's going to have a different set of implications. For investors who are thinking of leaning away from China, and I would say that leaning away does not necessarily mean trying to get zero China exposure. It could even mean a benchmark weight, because again, the benchmark is underweighted to China relative to its economic footprint, you have to think a little bit about, you have to acknowledge, in essence, the potential costs of that underweight. So when I think about that issue, there's theory and empirical evidence, for example, that cap-weighted equity returns over time are really, to a fair extent, to a great extent, driven by the very large appreciation of just a relatively small number of stocks. And why is that important here? Well, if you're thinking about leaning away from China and you're going to have a strategic underweight to it, in effect, you're saying, I want to restrict my opportunity set. I'm willing to restrict my opportunity set and take the risk of carving out some of these stocks that are really going to propel equity returns over the long term. The point is that strategic underweights have potentially material costs. The other sort of cost of leaning away from China, again, is underweighting that active opportunity set in the onshore Chinese market. And if you're looking for active returns out of EM, if that's one of your motivations for EM investing, you have to start questioning how you are going to go about addressing that deficiency elsewhere. And I think, among other things, in addition to just acknowledging that you're going to have to work harder, you need to think about quite expansive investment strategies that may actually extend beyond the contours of traditional emerging markets. And you really want to be thinking deliberately about investment process that, instead of sort of echoing developed markets or something like that, that are really going to focus in on or give you access to locally driven stocks, if you will. The final comment that I would make there is that for investors who are leaning away from China, you really have to ask yourself a question too, as to how much risk you're gonna, China risk, you may end up left with in ex-China oriented portfolios, or portfolios that are reducing their direct China allocation. The issue being that China has grown so large and it's so integrated into the global economy at this point, and that it's a material portion of global systemic risk. You can think of essentially an axis of systemic risk running through, say, the US and China. It's very difficult to walk away from that conclusion if you take a look at the data. And what that means is that in essentially any well-diversified equity portfolio, you're gonna have material China exposure. It's going to run through the global market factor. And given China's penetration economically throughout emerging markets, if you're looking at, say, EMX China allocations, you may even have direct China exposure that's fairly substantial simply through the relationships that China has. So that's a little bit of flavor from a high-level standpoint in terms of how different investors with different postures might think about the allocation issues.
Excellent. I've really enjoyed our discussion, especially delving into some of the specific data and research around this topic. I think it's really helpful. So thanks very much, Seth, for your comments.
Well, thank you for having me.
Yeah, it's been really great. And of course, that wraps this week's Monday Minute. And don't forget to send us your questions, and we'll get right back to you with our speaker's response. If you have questions, please just send them along. And thank you so much for joining us, and we'll see you next time. Thank you, Seth.
Thank you.